Today, we will talk about understanding the concept of an inverted yield curve and what it can tell investors. An inverted yield curve shows that long-term interest rates are less than short-term interest rates. With an inverted yield curve, the yield decreases the farther away the maturity date is. Sometimes referred to as a negative yield curve, the inverted curve has proven in the past to be a reliable indicator of a recession. The yield curve graphically represents yields on similar bonds across a variety of maturities. It is also known as the term structure of interest rates. For example, the U.S. Treasury publishes daily Treasury bill and bond yields that can be charted as a curve. Analysts often distill yield curve signals to a spread between two maturities. This simplifies the task of interpreting a yield curve in which an inversion exists between some maturities but not others. The downside is that there is no general agreement as to which spread serves as the most reliable recession indicator. Usually, the yield curve slopes upward, reflecting the fact that holders of longer-term debt have taken on more risk. Academic studies of the relationship between an inverted yield curve and recessions have tended to look at the spread between the yields on the 10-year U.S. Treasury bond and the 3-month Treasury bill, while market participants have more often focused on the yield spread between the 10-year and 2-year bonds. Federal Reserve Chair Jerome Powell said in March 2022 that he prefers to gauge recession risk by focusing on the difference between the current 3-month Treasury bill rate and the market pricing of derivatives predicting the same rate 18 months later. The 10-year to 2-year Treasury spread has been a generally reliable recession indicator since providing a false positive in the mid-1960s. That hasn't stopped a long list of senior U.S. economic officials from discounting its predictive powers over the years. In 1998, the 10-year/2-year spread briefly inverted after the Russian debt default. Quick interest rate cuts by the Federal Reserve helped avert a U.S. recession. In 2006, the spread inverted for much of the year. Long-term Treasury bonds went on to outperform stocks during 2007. The Great Recession began in December 2007. On August 28, 2019, the 10-year/2-year spread briefly went negative. The U.S. economy suffered a 2-month recession in February and March of 2020 amid the outbreak of the COVID-19 pandemic, which could not have been a consideration embedded in bond prices 6 months earlier. At the end of 2022, against a backdrop of surging inflation, the yield curve got inverted again. As of December 2, 2022, Treasury yields were as follows. As you can see above, the 10-year U.S. Treasury rate is 0.77 percentage points below the 2-year yield. That is an unusually large negative gap and the widest since late 1981, when the economy was pushed into a deep recession. The state of the yield curve suggests that investors believe we are entering hard times and that the Fed will have to respond by slashing borrowing costs. Or maybe not. Plenty of economists think the U.S. economy is heading for a recession. However, there are others who believe that the inverted yield curve of December 2022 is telling a different story. Rather than signaling economic turmoil, some say the negative gap might indicate that investors are confident that rocketing inflation has been brought under control and that normality will be restored. Here are 4 key takeaways. 1. The yield curve graphically represents yields on similar bonds across a variety of maturities. 2. An inverted yield curve occurs when short-term debt instruments have higher yields than long-term instruments of the same credit risk profile. 3. An inverted yield curve is unusual. It reflects bond investors' expectations for a decline in longer-term interest rates, typically associated with recessions. 4. Market participants and economists use a variety of yield spreads as a proxy for the yield curve. Hope this would help. Thanks for watching.